Hi friends, welcome to Stocks Daily, the channel where we invest smart so the billionaires can work for us. I wanted to make my first video on this channel about how to pick stocks and how I pick winning stocks consistently, because you might invest in Tesla and it pops and you think you're a trading god, but it's all about consistency. And as an experienced investor now, this is investment advice I wish I gave myself when I was starting out. So firstly, I like to say that you won't get overnight success. You could always invest in a company with 100x leverage just before it pops and get insane results, but you have just as good a chance as winning the lottery. And at least with the lottery, you don't lose your funds. Well, I guess you lose your initial investment, which is $1, but you get 1,000,000 times return, so that's a different story. Here, money makes money. The more you put in, the more you get out. Hence why it's so important to invest in winners and not just some dead stocks you put your money into and it does nothing for 5 years, or even worse, you lose your money. So let's get right into it. Number one, the first thing when looking for a company is to be forward thinking. The sector or sectors a company operates in are critical. You want to be involved in growing sectors, not shrinking sectors. Here's where your imagination comes into play. I always ask myself, what's the world going to be like in 10 years, in 20 years? Are retail stores going to be booming in 2030, or are online stores going to be booming? Are electric vehicles going to take over, or are ICE vehicles still going to be a thing? Are they still going to be the most sold vehicles in 2030? You have to look for emerging markets. Look, you can invest in value companies with great financials, great management teams and easy valuations, but how likely are they to double, triple, 5x, 10x in the next few years? How likely is it that retail banks or airlines are going to double and triple in the next few years? Or is it more likely that fintech companies like Square and PayPal will take the bank's market share and online meetings will reduce air travel? These are things to consider when looking for a sector to invest in. Be forward thinking. However, with emerging sectors, there's always risks. More risks, more reward. Simple. That's why you can't just invest in a company because you think a sector will boom. It's hard to see the future of a new company with new strategies and new tech. It might feel like whack-a-mole at times, always trying to chase the next big thing. That brings us to number two. The company's management team. Two of my biggest positions are in Square and Tesla. One thing that gave me conviction to buy these stocks before they popped upwards was the management. Elon Musk and Jack Dorsey both had great records, and I really believe that they could execute on their promises. You won't always find leadership on these guys' level, but if you research and watch a few interviews with a CEO of a prospective company you're interested in, it will become more clear if this guy's a phony or if he's for real. Nikola's a prime example. That clown Trevor Milton had an alternative energy vehicle company called D-Hybrid, which was sued by their partner Swift Transportation for failure to deliver. And his other ventures was a used car website that failed too. So ask yourself, would you invest in this guy's latest business, or would you invest in a company of a guy who founded PayPal or the guy who founded Twitter? Management is critical because the stocks are forward thinking. The growth or revenue of a company is normally at least 12 months in the future priced into the stock price. And if the management does not execute on the growth or revenue expectations, the price will drop. So you need a management team that can meet or exceed those expectations, and they can execute and not fail to deliver. Number three, the company should stand out from the pack. Something needs to be different, whether it's their approach, their branding, or the products, and preferably a mixture of all of these things. Personally, I love disruptive technology. Look at Beyond Meat, for example. They're almost a $10 billion company now. And that's because their products are innovative, their branding is great, and they have a unique approach that's different from their competitors. Tesla's probably the best example. Everything they do is innovative and disruptive. From the cars they make, to the factories that make them, to the way they market the products, the way they sell them, everything is different. And it paid off in their stock price. New approaches don't always work. There's risks involved. But to get big gains, you have to take risks. If Steve Jobs didn't come out with his iPhone, BlackBerry would still probably be a thing. But he took risks and it paid off. And the shareholders who believed in it got rewarded. Normally, if an emerging sector is on the rise, companies that stand out with strong management will get the most gains. So number 4, you found a company with good management in a growing sector that has some cool products. Next, you have to look at fundamentals. What's the company's balance sheet looking like? Look, traditional investors look at PE ratios and they want positive earnings. But if you're an early investor and you want monster gains, you have to come out of your comfort zone. Look at Amazon. It wasn't profitable and had an infinite PE ratio for like 20 years. By the time it was profitable, the stock was already crazy high. And if you invested then, your gains would be meager compared to if you invested when it was still growing. So when you're looking at a company's balance sheet, what's important is revenue growth and improvements to gross margins. If a company has everything we talked about previously, then gross profits will follow. Personally, I love companies that invest heavily into their own future. A lot of these companies won't have positive earnings because they're spending so much on investing in themselves. And to me, that's a clear sign that the management believe their strategy will pay off down the line. And that normally translates into increased stock prices, which is profits for you and me. If a company is complacent and they're not spending on innovation, that's a red flag. And you should consider selling that stock when it's up. So income growth and investment in themselves is critical for me. Now, the last thing I want to talk about is probably the most important. Number 5. Confidence, conviction. So you found a company that has all of the above. Good growth, bright future, great team. If you don't have the cojones to take risks and invest with a decent amount of money, then don't expect to get a decent return. And the worst mistake you could make is to see the stock go up 20% and to sell to take your measly 20% profits, only to see it go up another 100%, 200%. Don't invest money that you need 2 months down the line to survive day to day. You're better off investing and not looking at that investment for a couple of years. And if you love a company, but the stock's gone up ridiculously in the past year, which a lot of tech stocks have, for example, and you're worried that if you invest it might drop, then dollar cost average your way in. Never go all in with one big position. Buy a little nibble to open a position, add it to your watch list, keep an eye on it. If it goes down 3-4%, buy a bit more. If it goes down more, buy a bit more. Don't try and time the market perfectly. In most cases, if a company you found is great, other people will find it great too. And the price will ultimately head up north. So it's best to get in and not to worry about short-term volatility. The most important question you have to ask yourself is, what's the company's market cap going to be in 5 years, in 10 years? If the company is worth 100 billion today and you think it's headed to 500 billion, 700 billion, 1 trillion by 2030, then it's a no-brainer. That's a 5x, a 10x from today. It doesn't matter if you buy it a few bucks lower or a few bucks higher, so long as you have the position in the bag. If you have conviction and confidence, as the stock price drops, don't see it as a loss. Don't get scared and sell. See it as a flash sale for yourself. Buy more. Load up so when it does go up, your profits are even bigger. So, to sum up, when you're picking a stock, look for emerging markets, good management teams, companies that have something different, revenue growth and self-investment, and then have the confidence when you're investing, have that conviction. Another very important part of investment is when to sell a stock. And that's usually when a company's fundamentals change. But that's a video in itself. So please like if you like the content and subscribe so you can catch the next video. Thanks for watching. You've been awesome for staying for this long.